Last office hours of the semester. Putting on pause. We're seeing if somebody else will join me. And just so I don't forget. All right, we are here. Let's see what we got. Let me share a screen and we can get started here in just a second. Share, and we'll go with that screen. Perfect. Okay, I think we're all set. Financial accounting. Okay, any questions you have as we come to the end of, what is it?
I was just going to have you just do a quick run through of just 9 and 10. I get confused a little bit on the payables versus the expenses on these initially. And then 10, I haven't gotten too deep. I mean, I've read it, but didn't get super deep into the bond issue.
Okay.
And then mainly just an overview of the final exam.
Yeah,
So I have no real other questions, no specific.
that's perfect. We can work through that. Let's see, maybe we should just, let's see, 9, 10.
I don't know if there's any trouble spots that you normally see in 9 or 10. Maybe just go over maybe trouble spots that people have.
Yeah, let me see if I can find some. Let's see, let's go back here. Okay, so definition of a liability, that should be okay, what you owe somebody. Current liability is within 1 year. Long-term is after that. There's some uncertainty. That's usually not the biggest issue, but there is usually an evaluation of that, but not big. Okay, so accounts payable. Now, accounts payable typically comes from invoices that are sent to you from a vendor, a consultant, a supplier of some sort. And it's usually at some, terms. I think we've gone over the terms before, like 2% net, 2% 10 net 30 or something like that. Or just net 30, or many times these days is more like net 45 or net 60. So that shouldn't be too bad. It's pretty much straightforward. In the system, you just record the invoice and it does the entries automatically, but generally it's a credit to accounts payable and a debit to some expense account. Generally speaking, it could be though an asset account if it's for equipment or something that goes into inventory. Sales tax payable. We all pay sales tax when we go to the grocery store or gas station or whatnot. Companies collect that and then they remit it to the government of various governments. Could be state, could be local. And generally speaking, those will be broken out, right? So you'll do your let's say it's a cash sale in this case, and it's a 5% sales tax, so it's 5% on 6,000. So you will have collected $6,300, and 300 of it gets set up in the sales tax payable. Sometimes they break these out, sales tax payable for one locality for another, but in this case, they're just generalizing it. And so it's a $300 credit. When you actually go to pay it, then it's a debit to sales tax payable and a credit to cash, just the opposite. Unearned revenues, we've talked about that in prior chapters early on. When we recognize the cash received but hasn't been earned yet, so it'll go to an unearned revenue account on the liability side of the balance sheet. And then when you actually recognize it, it'll get credited out of that account and into a ticket revenue income statement account. So this is balance sheet, this is income statement. Short-term notes payable, think of your mortgage, but a shorter term. Or like, think of something bought on I don't like you buy something, a big piece of furniture, right? And you put it on credit. It's a note that's due at some period of time, and there's an interest rate associated with it. So you just have to be able to calculate the interest rates and record that over that period of time. So
Well,
here
and
you
I
said,
think,
go
yeah, and I
ahead.
think just given my age and all of my life experience, this
Uh-huh.
has been, very understandable material because we've probably been through it a time or two.
Yeah,
So,
it's the biggest issue here typically is recognizing the interest due between two different periods.
mhm.
And so, it's not always a nice, easy cutoff, right? A, beginning of the month, end of the month. Usually you do these things mid-month. And so you have to be able to split that out by the number of days in one particular period versus another. And did they show that? Yeah, right here. They show that when it extends over two periods, right?
Mhm.
So 15 days in one period, 45 days in another period, and they're looking at years in this case. And so they're splitting it out between years. It'd be the same case in terms of months. So this would actually be 30 days worth of interest in January and another 15 days effectively worth in, well, actually, no, it's 31 days in January and 14 days in February that you'd split this out. But you want to be able to split it out based on the period that it's associated with. So I think most of that's pretty straightforward. There's not too much in there that causes, I think, too many problems. You just have to be aware of the accounts, right? Where what's getting credited and what's getting debited. Taxes, I don't know, payroll taxes, those are a big deal for most companies, keeping track of those. Because they pay you in gross, but in effect they pay you net of everything else that gets taken out, federal, state, any voluntary deductions that you're making, like to your, let's say, your health savings account, or to an FSA, well, I can't even think what it is anymore, a flexible spending account. And then you have your FICA broken out between Medicare and Social Security. So they walk you through this. These are important to remember, right? What parts, and I'm not sure if this actually comes up in the test. So we'll go through the guide real quick, but definitely 6.2% up to a certain value is taken out. And then Medicare is 0.9% regardless of the amount. Oh no, 145. There's no limit and additional. Oh, okay. So it usually is just, you have to worry about the 1.45%. But that all gets set up, and this is your gross pay. These are all your individual deductions that go into a special account on the liability side, and then your net pay is this. Yeah, so it'll be usually what you'll have is the first. Well, okay. So they're setting up the liability here, and then they pay it out later. There we go. There's the payout. So they're setting up this is your income statement account, salaries, expenses for 2000 minus all the deductions equal the net pay. This gets set up as a payable. And then when it actually gets paid, then you relieve the payable and get paid out of cash.
So that salaries payable, was that a net after those deductions?
Yep. Yep. So you start
And
out with
then
the
that'll be
gross.
what you pay. Okay.
Yep.
Okay.
You start out with the gross, you calculate all the deductions, and then whatever's left over is in the net, is set up as a salaries payable. And
Okay.
then this gets cleared out when you actually pay the
Then
payroll.
those match that.
Yep.
Yeah.
Yep.
Okay. Debit to, okay.
Yep. So these usually is not as clean as this in real life, because this is done for every single person, right? And automatically generally. And so this would be an aggregate value that's recorded for however many employees, 500 employees, let's say. And
I see.
then when the individual employees are paid, and once again, it's in an aggregate, but it's all, you can tie it back to each individual employee one way or another. And there's a lot of reconciliations that go on just to make sure that that's all working appropriately. And this goes through those individual taxes. Oh, this is the employer side. So this is the employee side of the transaction. Usually there's an employer component to each of these taxes. Mostly on the FICA, oops, and the FUTA. So it'll walk you through that on here. Your FUTA, your SUTA, both unemployment components that the employer pays into these government entities. And then so they record the same thing. They'll do an analysis of, how much what the tax expense is and on the payroll that was made. Yeah. So that's pretty much it. I mean, it looks complicated, but you really just have to remember there's an employer component, employee component. You set up the pay, you start out with the gross, you work yourself through all the different deductions and your net salaries payable. And then this is the employee component of it, and this is the employer component. And then these all get relieved at some point, sometimes on a monthly basis, sometimes on a quarterly basis. It really depends on the size of the company's payroll. Okay, estimating liabilities. These shouldn't be too bad. But and I've had questions in the past from students that are in Nigeria or in Chile, and they're wondering like, well, how do I know, what the employee benefits are? You really don't need to worry about what they are. You just need to focus in on what they tell you it is. So like in this case, they contribute an additional 10% of the employee's 120 gross salaries to a retirement program, right? Plus they pay $8,000 for medical insurance. So you just need to know these variables, right? And to do the calculation. So this would be $12,000 goes towards the employee retirement program, and 8,000 goes to their medical insurance payable, right? So they set these accounts up. These are the liabilities, and this is the expense side of that. And usually in the questions, if they have one on employee benefits, they're going to be pretty specific like this.
Okay.
On vacation, this one should be about as straightforward as well. Because they're going to tell you, 2 weeks paid vacation. Now, I think, okay, it's pretty straightforward. So 2 weeks paid vacation and 3,200 of accrued vacation. So you just really need to know the accounts: vacation benefit expense and payable. And I think as long as you're close to this, you should be fine. And the $3,200. I was contemplating a little bit this part. Sometimes this can be tricky in the sense that they might say, you've earned 40 hours and your pay rate is $10 an hour. And so you have to do the calculation of the value, whereas in this case, they gave you the value. Right. But in any case, it'll be very similar to, these, where they'll give you two components of the math and you just have to do the calculation.
I think the biggest thing that I found doing the little questions was reading employee versus employer, get it in your head. Don't assume that they're still talking about one when they've changed it, and sometimes they just want to know the principal, and I'm thinking principal and interest, or I'm thinking interest. And it's just, again, goes back to read the story problem.
Yeah, the devil's in the story problem. You're getting that right. So this is where they set up on vacation. This is where they set up the liability, and then they pay it out at whatever period of time. So, you may accrue 2 weeks worth of paid vacation, but you only take a certain amount. You only took 1 week or whatever that happens to be. Bonuses are the same. Warranties, very similar. In almost all these, all you're doing is setting up a liability and you're expensing it for almost all of these. And so you just have to read through the problem and then figure out what the value is, and then just set it up and code it as initially as a credit to a liability and a debit to an expense. And then when you go to pay it, you're paying it out of you're paying it out of cash. So you're effectively crediting cash and you're debiting the liability. In this case, I think this is an end of period adjustment where maybe the warranty lapsed. Either way, estimated. Yeah. Well, actually, they did some work against the liability. So they're just taking the parts out of the inventory and they're debiting the liability, therefore reducing it. So that shouldn't be too bad. I think what's in here covers that pretty well. Accounting for contingent liabilities, rules, the claims, debit, contingencies. Warranty is, I think it's just really a continuation of warranties type stuff. There's nothing too significant here. Let me just pull up the guide. Let's just see if there's anything else in chapter 8. Okay. Oh, chapter 8.
We're in 9 and
We're in 9, sorry.
9 and
Okay.
10. Yeah, 9 and 10.
Ooh. Chapter 5. What's going on? A little slow for me. Okay, so this is a summarized view of chapter 9 and 10. Where's the other part? Because that was part of the final exam. Exam 5. This must be 7, 8.
Because all we have, I think, this week is maybe a quiz and quiz access and a quiz. And then it goes to the
Oh,
final.
that's right, because then it's included in the final exam. Thank you.
Yeah.
Appreciate that. Yeah, I was wondering. Okay, so exam 5 in this guide is the final exam. It does cover all the chapters before that, and so this will give you a quick review of the key principles from each of those that's going to be testing you on. And then so on the final for 9 and 10, is this going to be asking about what's the difference between accounts payable and notes payable? Key distinguishing components are, this is an invoice and this is really more like a security. It's
I guess I was thinking it was probably just interest.
Yeah, there will be interest on this one,
Mhm.
whereas usually there's not interest on accounts payable. That's a good distinguishing factor. Identify and compute payroll taxes. All right, so they'll give you most of that information, but you'll probably want to remember components of it. But I'm not sure if they give you the percentages when you're in there. They'll definitely give you like the federal tax rate. They'll give you the state tax rate because those aren't always given. The federal and the FICA, you'll need to know the 7.2%, right? No, 6.2%. What is it? Go back here. This is a total of 7.65 if I remember right. Payroll taxes, employee payroll taxes. 6.2 on the social security piece and 1.45. So it's a total of 765. Yeah. So you'll definitely want to remember these if just in case they don't give them to you. I wouldn't be so concerned about the max because they usually don't cap out in the calculation. Because that's by person.
Mm-hmm.
And so I wouldn't worry too much about that. I would just worry about the 6.2 and the 145. Oh, let's see. Where was I? I was on PDF. There it is. Okay. Compute salaries, wage expense, and taxes withheld. So you have to go through that whole, breakdown. Or if you got FUTA, you got FICA, you got federal income tax, state income taxes on the employee side. You got the FICA, and the Medicare component of that, and then any other deductions that they might identify. So you have your gross, taxes withheld, and then your net. So you want to be able to compute that for sure. And want to know how to journalize. This is anything accrued revenue type, ticket sales type things. So remember, you got to set up your, you got to debit to cash and your credit to the accrued revenue account. And then when you actually record it, it's a debit to the accrued revenue account and a credit to the ticket sales account or whatever it happens to be. Journalizing unearned revenues, same thing, dealing with same types of issues here. And then credit sales with taxes. So, they'll give you a tax rate, whatever, 7% of the sale. We have to journalize that as it was shown in this one. So I think the ones I went through pretty indicative of what. There we go, sales tax. This will be your typical journal entry for that. Typical journal entry for unearned revenues. Right, so you want to make sure you go over that.
Okay.
Just want to see if the cheat sheet shows all that. Summary, comprehensive. Nope, wrong one. Not that one. It's usually there's a, oh, there it is. Summary cheat sheet. Journals, journal entries, taxes. Yep. This is a good summary of everything that's there. But you'll know that there's only a few things that they're covering, just what's on here. Chapter 10